All right, welcome everyone. A good day to all of those logging on. As the president and COO of Asset Strategies International, Rich Checkan has been an integral part of ASI's maturation to a full-service tangible asset provider to include precious metals and rare U.S. world and ancient coins. Mr. Checkan oversees the operations, administrative, sales, and marketing departments and serves as ASI's compliance officer. He is a regular contributor to Escape Artist Insiders magazine and ASI's monthly newsletter information line. Mr. Checkan speaks yearly at numerous conferences and seminars worldwide and has been featured for his expertise on industry vlogs and podcasts, and has been quoted in countless financial newsletters and the New York Times. Rich, always a pleasure. It's all yours.
Thank you, Mark. Appreciate it. And good morning and welcome to everybody for joining us here this morning. Looking forward to a fantastic event. I've seen the speaker lineup and it only gets better from here. Today, I want to talk about something that I think is very, very important. It's near and dear to my heart because I think it's coming and some people are prepared and others are not. It's how to prepare for the coming stagflation. And we can argue whether we're in stagflation already, if you don't believe the government numbers, unemployment and the like, or if we are about to be in stagflation. But I got to tell you, the pain is real, regardless of where you think the needle falls right now. So let's get right into it. I just want to give a little bit of background, and some of these slides I'm going to go through fairly quickly because I think many of you know us by now. I just want to make sure I have time at the end to handle some questions. As I was telling Mark earlier, I much rather handle the questions that you ask, so I know I'm dealing with what's on your mind instead of what I think you may be thinking and want answered. So I think everybody's familiar. Asset Strategies International is our firm. It was formed 40 years ago. We're a precious metals dealer for both bullion and rare coins, US, world, and ancient. What sets us apart is customer service. On my background, the biggest thing is I've been here 26 years. I've been involved in every asset of the business, or every facet of the business. And I do have a little bit of military background, and that's going to come up here shortly in some of these slides. As in right now. Any military officer, and I was one, probably did get through their career without reading a little bit of Sun Tzu in The Art of War. And Sun Tzu had many famous quotes. One of them is, if you know the enemy and you know yourself, you need not fear the result of 100 battles. Okay. And the important thing to know is, who's your enemy? So I ask you, who is the enemy of your wealth? Okay. Is it this gentleman? Vladimir Putin. There were a lot of comments earlier in the year that, this inflation was created by basically Vladimir Putin's war on Ukraine. Is he our enemy? Is he the enemy of our wealth? Is this the enemy of our wealth? Chairman Jerome Powell. A lot of people will make the case that Jerome Powell has done some things in terms of raising interest rates and pulling the punch from the party and deflating asset values for the majority of this year. And many feel that he took those steps too late after he and his team created the inflationary monster that he's trying to fight right now. And he played it off, said, we didn't have inflation. We don't understand inflation. Oh my God, we have inflation, but we can deal with it. So a lot of people are putting the blame on Jerome Powell. I think some of the blame goes there. I'm not happy with the fact that they don't take responsibility for increasing the money supply, which by definition is inflation. But I also think Congress has a role to play in this. On both sides of the aisle, we've been spending more money than we've taken in for generations. And as a result, Powell's put in a position where he only has two choices. He either needs to inflate the money supply or he needs to let the dollar default. Neither one of those are very good options, and I guess inflation is the best of the two. Make no mistake, this is all by design. I sat in the front row when Alan Greenspan spoke at Brian London's New Orleans conference a few years back, where he said basically, that they really didn't have a choice at the Fed, that he went against all his principles and his belief in gold and his belief in the principles of Ayn Rand, just because he had no choice in what he was doing. I think they have a systematic plan in place here. After the 2008, 2009, whatever you call it, collapse of the economy worldwide. Ben Bernanke, chairman at the time, basically said, if people feel, and important, feel that their financial situation is better because their 401k looks better, or for whatever reason, their house is worth more, they're more willing to go out and spend. That's going to provide the demand that firms need in order to be willing to hire and invest. The important thing here is they really don't care if you are wealthier. They just want you to feel wealthier. And it reminds me of that old Saturday Night Live sketch. It's better to look good than to feel, or to feel good than to be good, or something like that. But the bottom line is they just want you to feel better, because then you're going to spend. That's what consumers do if they have that wealth effect kicking in. And, we saw this. They created this bubble. House values, home values went sky high. Asset values in the stock markets went sky high. Your 401k was stronger. Your retirement looked good. Your asset accounts looked great. Everybody felt wonderful, and they're spend. The problem is that those values were all falsified, if you will. It was a bubble, and those values weren't real because they were measured in inflated dollars. But everybody had that wealth effect, and that is the plan. Make no mistake about it. So we created this monster. Along the way, this thing called COVID, worldwide pandemic, came along. It triggered shutdowns, which basically choked off supply. We disincentivized workers. We basically paid them to stay home. Okay, we sent stimmy checks to keep people at home rather than go to be productive at work. That also choked off supply. The worldwide supply chain ground to a halt. We're still dealing with those supply chain disorders. We had hyperbolic monetary expansion. 25% of all monetary expansion occurred within like a 2-month period after COVID. That obviously increased demand because we put that money directly in the hands of consumers and small businesses through stimmy checks and payroll protection plan loans. So demand is spiking, supply is choked off. What could possibly go wrong? We have inflation, and it wasn't created by the war from Putin. It's been around for over a year now. Putin didn't let loose his army until the beginning of this year. Inflation was already climbing at the end of last year, and it's like a pickpocket. The CPI is about 7.7. People feel like it's kind of steadied or is slightly moving down, and they feel a bit more comfortable. But that's 7.7% rise in everything, in prices of everything that we had in 1 year. The PPI is at 8 point something, 8.5, I believe it is on the last reading. The new readings come out December 9th and 12th for PPI and CPI respectively. But the PPI is important because that's still very elevated. And when the cost of the raw materials to producers go up, they will pass those costs on to individual consumers. So CPI is not done yet. We still have more inflation in the pipeline that's got to work its way through. And the net effect of all of this is our standard of living drops. I think everybody has seen it, at least in this past year, if not prior to that. So that leads us to stagflation, which by definition is a sluggish economy. And we've had one. We had a slightly positive, I think about a 0.5% increase in GDP in the third quarter. First and second quarters were flat and negative. So for the year, we're flat or negative. We have persistently high inflation. It's been over a year now at levels that we haven't seen for 40 years. And we're looking for rising unemployment as the third leg of that stool for stagflation to be present. Now, folks that don't believe the government numbers think that rising unemployment is already there. We're at the levels we should be concerned about. We're just not counting anybody anymore because they dropped out of the workforce completely and therefore are uncountable. It doesn't really help our numbers. There's no more people working. Bottom line, whether we're in stagflation or out of stagflation, we're very close, and it is the worst of all worlds. Assets, basically everything we own, everything that we have to be able to pay for what we need is dropping in value. We're seeing it so far this year. I'll just run some numbers past you. They've been pretty consistent all year long, but the Dow, one asset class, down 6.58% for the year. The S&P 500 down 16.1% for the year. The NASDAQ down 28.16 for the year. Bitcoin, over 60% drop for the year, down to 16,000 from about 69,000 this time last year. And, nothing is really immune. Gold and silver are down as well, although gold, I believe at this point, is only down about 3% for the year. But all of the things that we have that we count as assets, and believe me, home prices will be falling too with rising interest rates, make no mistake. The assets are falling in value, and at the same time, we have the cost of everything that we need to survive going up in price. It is the worst case scenario. And it leads to some interesting things. I'll just throw some numbers at you. So far, we're looking at 32% of the population is late on bills. Credit card debt is exceeded $1 trillion. And we're seeing it across the board. Auto loans, mortgages, you're going to see defaults coming in. And there's going to be some real credit issues, both at the consumer and at the corporate level. So with stagflation coming in, the worst case scenario, how do you beat it? And you can. Let's face it, we've been through this before, sort of, and I'll get to that here in a second. The way to beat inflation is, one, seek stability, okay? In my opinion, unless it's well thought out and you've already got the plan in place and you're basically just working through the plan, you want to not make any major changes in your life. It's not the time to go looking for a brand new job or start a company on a flyer. It's not a time to start moving around residences unless, again, all these things are well thought out. That's wonderful. But if you're just going to do it on the spur of the moment, it is not the time to do such things. There is enough variable going on in the economy where you don't want to add any more instability into your life. Two, if you don't do it, you should. I know Congress doesn't do it. They really don't care how much they're spending, but we do. And you need to analyze your spending and make sure that your spending is going to your needs as opposed to your wants. If you have the extra money and you put it toward your wants, that's fine. But I think number three kicks in here. Establish and augment your savings now if you have the capability. It's going to get worse from here, folks. So make sure you're prepared for it. Put something aside. As our one of our founders, my uncle Michael and his partner Glenn Kirsch started this company 40 years ago. Glenn would always say when I first got here, pay yourself first, every paycheck, right? So when you get a paycheck in, go ahead and take some money off the top and put it into savings. Do that now, do it more than you normally would. And then once you have that savings, I think you want to store some purchasing power. And there's a few ways you can do that. Obviously, one, the proven way for 5 millennia is through gold and also a little bit to silver. Go ahead and buy some precious metals. They're a fantastic store of purchasing power over time. But I would also consider, looking at anything that people need, not want, anything that people need. So, if you want to look at real estate, if you want to look at precious metals, if you want to look at agriculture, energy, these are the things that are going to be there no matter what, because no matter what happens, people are going to find a way to keep the lights on, to keep the food coming, etc. Fifth, make your vote count. I mean, we just had an election, but there'll be more in the future. I don't care if they're Republicans, Democrats, Libertarians, Green Party, whatever political affiliation you come up with, it doesn't matter to me. Apolitical on this issue. If they are bad stewards of our money, kick the bums out of office and put in office somebody who's fiscally responsible, somebody who's going to not spend more than they take in, because there's no other way out of this, folks. Jerome Powell can raise interest rates till the cows come home. He can get 20% on top of inflation. That's great. He is never, ever going to solve the problem until Congress stops spending more than they take in, because they keep creating more future problems for Jerome Powell and his successors. So kick the bums out if they don't know how to balance a checkbook. And the last thing is, be happy. We have been through this before. Now, I said almost. Big difference between the 70s when we had stagflation and we did come through it, and now is one big difference. We have a $31 trillion anchor hanging around our necks right now that we did not have in the 70s. So there is a limit to how high Jerome Powell can raise interest rates because he won't be able to service the debt. It is too big of a number for him to handle. And that's something Volcker wasn't challenged with in the 70s. He was able to get on top of inflation and bring it back down with interest rates. Powell cannot go as far as Volcker did. But all that aside, it sounds negative. I'm a negative Nelly and a Chicken Little. I'm not. I am an eternal optimist, and I believe in America and Americans. Be happy. We are going to get through this, and we're going to get through it together. Little things, open the door for somebody, say good morning to somebody in the elevator. The masks are off. Take advantage of that. Show somebody a smile and see what that'll do for their day. Little things matter. We will get through this. One of the ways I mentioned that you can do this, you take some of that augmented savings and you go ahead and put it toward real value. This is your wealth insurance. This is how you keep what's yours by storing purchasing power going forward. The gold is primary, silver secondary here, just a little bit for divisibility. It's typically about 10% for insurance. Most people will tell you that comes from studies where they looked at different mixes of stocks and bonds, different mixes of gold in different currencies. And there's a sweet spot right around 8 to 12%. Everybody usually goes with 10% because the math's easier. But insurance is a great reason to own gold. And in this environment, profit is a potential as well. And profit's not a 4-letter word, folks. It is a 6-letter word. I counted it right up there on the screen. Although you don't typically get better results for your portfolio by owning more than 10% gold or less than 10% gold, there are certain times when gold and silver are poised to increase in value. I do believe this is one of them, given the indicators. So even though you typically gravitate toward that sweet spot of about 10%, I think right now is a time you might want to consider augmenting those holdings. Wealth insurance, by definition, is the store of purchasing power with high liquidity for a potential financial crisis you hope to never have. And the way you use that is you allocate it. You go ahead and you put that 10% in and you never, ever touch it unless you have an emergency. Once you have an emergency, you go ahead and you sell whatever you need, you meet the financial obligation, and then as soon thereafter as you can, you replenish your emergency holdings in gold for that future financial catastrophe you hope to never have. If you never have an emergency, great. You never have to sell anything, pass it on to your heirs, your number one cause, whatever it might be, give your kids a start in life. And when it comes time to buying gold for wealth insurance, here's what I believe. When buying gold for the right reasons, there's no such thing as the wrong time or the wrong price. We continually measure gold in fiat currency. I'll get to why you really can't go wrong long-term because of that. The profit motive for gold is a little bit different. As you can see, people will tell you gold has done nothing. It bears no interest. It bears no dividends. But gold has moved up in dollar value pretty consistently since we decoupled from the dollar in 1971 with President Nixon. Silver has done the same thing, but with a bit more volatility. When people say that gold can't perform, I disagree. You look so far this millennium, 22 years in, and the Dow is up 199%, S&P is up 175%, NASDAQ's up 172%. All are fantastic returns. Silver is up 318%. Gold is up 514%. Okay. I don't care if it doesn't have interest or dividends. It performs. It holds its value over time. Why gold? Because I told you the conundrum that the Fed chairman always has. Because the government spends too much, they either have to increase the money supply, which is inflationary, or they have to default on the dollar, which they're never going to do. Okay. So as long as you see the money supply going up, gold will go up in price. There's just no two ways about it. And it's because of broken measuring sticks. We use the wrong thing to measure value in this world. If you ask me, we should be measuring value with gold. It is a constant. It stores value. You all have heard the story about the man with the suit, right? So in Roman days, we bought a toga with an ounce of gold. It was the business suit of the day. In 1918, we went ahead, or 1913, when the Fed was created, we spent $18 for a brand new suit, business suit of the day. 1 ounce of gold was $18. Today, business suit does not cost $18. It costs well more than that. But gold will still buy it at $17.70 an ounce this morning. Okay. Gold is a store of purchasing power. It is a store of wealth. It is a constant measure of value. Compare that to the dollar, which is not. Again, we have mismanaged fiat caused by unbridled spending, anemic revenues, skyrocketing debt, and the ensuing monetary expansion. What could possibly go wrong? When I look at a unit of measure, let's say you take a ruler, a 12-inch ruler, and you measure a 6-foot desk. You're going to take 6 lengths of that ruler. It's going to be a 6-foot desk. If that night I went ahead and cut 1 inch off the end of that ruler, and the next morning I measured my desk again, that desk is now 6.5 feet long. Did the desk grow? Heck no. The measuring stick shrunk. It's a bad constant. It's a bad unit of measure. The dollar is a bad constant, is a bad unit of measure. We should measure everything in gold if we want to get a true price discovery. Actions to take. Give us a call, okay? Send us an email. Discuss your goals with us. We are not paid. Our staff is not paid on commission, okay? So they are not going to try to push you into something that makes them more money. If they do, they'll be fired, okay? They know that. They have your interests in mind. Discuss your goals with us. We'll help you establish a plan, allow you to buy on the dips and build up your wealth insurance and build up your for-profit metals. By all means, sign up for our free newsletter and alert service. It is free. People that get it for years tell me they believe it is worth every single penny. We want to give you a free consultation. Call us up. We want to talk to you. We want to work out what you need to accomplish in order to make sure your wealth is protected so you can keep what's yours. And when you buy from us, we do buy and sell precious metals and rare coins. With every qualified purchase, we'll give you a free silver eagle just by mentioning that you came to us from the Money Show. We've got our contact information. I believe all this information is going to be shared with everyone. So you'll have ample way to get a hold of us. We've been around for 40 years. We've designed some incredible programs like the Perthman Certificate Program now, and its silver anniversary is 25 years. We've been around a long time taking care of people with zero complaints. So let us add you to the resume of the people we've taken care of going forward. Let us help you keep what's yours. And Mark, with that, I'd just like to open up for questions. I hope I didn't talk too fast and leave anybody in the dust, but I really wanted to get to what's on everybody else's minds at this point.
All right, Rich, thank you so much. We do have just over 5 minutes for some questions. We had one viewer, Gary. He is wondering, when investing in gold, do you recommend investing in gold stocks or investing in the actual gold metal itself?
Yes. How's that? I know I'm a firm believer in gold stocks as well. And clearly, as you just heard in the presentation, I'm a firm believer in physical precious metals. The one trick or the one catch to make sure you don't fall into here, the pitfall, is they're two different assets. Okay, when you're looking at mining stocks or resource stocks, these are equities. Okay, so whatever your equity allocation is, that's where they should go. Yes, they're related to precious metals in that we're mining gold or silver or platinum or rhodium or whatever the case, uranium, but they are not ownership of precious metals. So it's great to have some allocation in your portfolio. Usually you want some good guidance, and I know there's people on this panel over the next 2 days that fit that bill. I could just name 3 or 4 right off the top of my head, but it's an equities allocation. What I spoke about, the 10% for wealth insurance and potentially, for profit motive, maybe another 10-15% of investable assets in times like these, that is physical precious metals, okay, for wealth insurance and profit, not stocks. Don't mix the two up. And if I could just elaborate one more, the reason I say that is, I'll give you an example. I won't mention the company's name, but we held a mining stock back in 2000, 2001. The company was doing great, had proven reserves, had proven management. They had followed Newmont Mining's lead, and they had stopped their forward selling. So rather than sell precious metals they were mining today at or tomorrow for tomorrow's production at today's prices, they would let it sit, and they were going to sell it at tomorrow's prices because they believed they'd move higher, and they were right. They had everything done perfectly to participate in the gold bull market that went from 2001 to 2011. Gold did its part; it shot up. This company's stock value went through the floorboards, and it has not recovered to this day. Something as simple as the mine flooded, and they have environmental concerns that they haven't been able to sort out for over 2 decades now. So understand, you own a mining company, you have the potential for outsized leverage returns as a shareholder if they do their job well and return those profits to shareholders, but you own zero gold. And you do have other variables in there mixed in where gold has no variables, no management, no mismanagement.
All right, excellent. Thank you. One of our viewers from Germany, Stefan here, he's wondering if you're able to take on any international clientele, specifically German.
We absolutely can. We have a few different ways to do that. We have shipped metals internationally. Obviously, well, not obviously, but I will tell you it's a lot easier to ship into Europe than it is to ship into certain Central American countries, for instance, where the rules are constantly changing. So yeah, that's absolutely possible. We could as well sell to you and arrange for storage domestically. It would cut down on the cost of storage because international armored couriers do cost money. And we could either store domestically or in something like the Perth Mint Certificate Program, where if you own a lot of Europeans will hold, say, silver or platinum at Perth Mint, because if they don't take delivery of it into Europe, they don't have to pay the VAT tax or the value added tax on the white metals. So there's ways that we can probably help you that others can't. By all means, get in touch with us so we can explore the possibilities.
All right, thank you so much. Another viewer here comes in and asks, is investment in precious metals suitable for a Roth solo 401k retirement plan?
Absolutely. In fact, I think that's the best vehicle on earth for it, especially in this environment, because you won't have to pay the gains in the future when you start taking distributions. But yes, since 1997, we had, well, let's go back, 1986, you were allowed to put gold and silver eagles in your IRA, all forms of IRAs. Since that time, the Roth was created. In 1997, they came out with the Taxpayer Relief Act, which broadened what you could own. You can own gold, silver, platinum, and palladium, as long as it met LBMA finest requirements, and it was approved for ownership in different depositories. So the bottom line is you have a wide range of precious metals that are available to you, both for storage domestically or abroad within your Roth IRA, and it is a fantastic vehicle to do that as long as Congress doesn't come in and change it.
All right, thank you very much. Another question here states, do you foresee any oil shocks like we had back in the 70s that would fuel stagflation more? I know the prices of oil just keeps going up and down, up and down.
Yeah. It's funny. I'm getting all sorts of mixed reviews. The bottom line is I remember those oil shocks. I mean, I was born in 65, so I remember in the 70s waiting in the gas lines on odd and even days in New Jersey, depending on your license plate, hoping to get gas before you ran out of gas, waiting to get gas. Those were not good times. It's part of what fueled the stagflation of the 70s. Yeah, I think we're poised to do that, especially since we weaponized the dollar. Russia came back and weaponized. I heard somebody say the other day, they've weaponized winter because it's going to be cold and they're not going to have fuel when Russia cuts you off. But the bottom line is they've weaponized fuel, and they're in a war. Whether they started it or not, they're in a war. They're using all the tools at their disposal. I think there will be an impact. And there's some folks out there. I'm not going to plug any other folks out there, but there's many that are talking about the potential problems with the shift to green energy and the fact that we're not quite ready to go there yet. And you start cutting off or disincentivizing those that are going for petrol, petroleum-based fuel sources or dirty fuel sources when we still need them badly. So yeah, I do think there are going to be shocks in the future.
All right, thank you very much. We do have about a minute remaining here. Another question coming in. Do you think it's safer to have the Band-Aid ripped off and force a recession completely, since they usually last only maybe a year? Or do we just try to keep trying to recover for stagflation and drawing it out with no recession?
Well, if you had a cure to a sickness, would you want to take that, or would you just want to treat the symptoms and keep the sickness forever? There's my answer. I'm 100% believer in free markets. Let them work, for God's sakes. The answer to high inflation or high prices is inflation. If the prices go up, people stop buying and they'll come down. That's what free markets do. I don't need a government to dictate that. I wish the government would get the hell out of the way, to be honest with you. Let the free markets work. And I think the reason we're in such pain right now, and I think it is going to get worse, although not unbearable and not life-threatening, the reason it's bad and getting worse is because we did not deal with the ailment back in 2008, 2009, and prior. The miscues that led to those issues, we papered over them, we band-aided them, and then it just continued to get worse and worse and worse. Every bubble's got to find a new bubble, and I don't think it has to be that way. I think if we let markets work and let price discovery occur naturally, I think we'll be in much better shape. And yes, it will be painful in the short term, but it'll be much less pain in general over time, in my belief. Good point.
All right, everyone. Well, you're watching Money, Metals, and Mining Virtual Expo. We are speaking here, Rich Checkan. Rich, thank you so much. Brilliant presentation.
Well, thank you. I love coming here, and thank you all for joining us.
All right, have a great one. We'll talk to you soon.